M&A Unplugged community, welcome back. Today is episode 16, and we have a repeat guest joining us today, Tad Render, who is the head of the transaction services group at Miller Cooper. Miller Cooper is a mid-market accounting firm here in Chicago, 11th largest, tremendous firm. We've had the opportunity to do a number of transactions with Tad and his group, and they are an excellent organization. And if you haven't listened to Tad's previous episode, it's really full of great information for both buyers and sellers, people who are really considering selling their business and how to prepare it. But today's episode, I sit down with Tad and we're talking about the 10 commandments of selling your business, what you really need to know about as an owner of a business if you're looking to prepare it. And this is based on an article that Tad had written some time ago. I had some minor input to it, but it's a great blog post, and we've turned it now into a podcast and hope you enjoy it. But I also really wanted to take a moment to offer a big thank you to everybody in the M&A Unplugged community. The show, we're only 15 episodes in, 16 today, has gotten off to a tremendous start. Beyond my wildest dreams, to be honest with you, we are getting a tremendous number of downloads every week, and it's actually been listened to in 32 countries. I would have never imagined that when we first started this. So I want to thank everybody who is listening in, and I'm hoping that you're really enjoying the content. And in keeping with the spirit of what our original objectives were, making sure that we delivered really good, relevant content to people who are considering buying or selling a business, to that extent, if there's something that you would like to hear or know about, I'd like to offer up my email address, have you send me your thoughts and requests, and I'll try to line up experts in those areas. Or if it's something I think I can talk about, maybe I'll do a solo show on it. So please, send me your emails if you'd like to hear something specific. You can email me at drinaldi@sunacquisitions.com. That's DRINALDI @sunacquisitions.com. And again, really thank everybody that's been listening in every week. Really means so much to us. And if you're really enjoying the content, please take a moment to share it with your friends and colleagues. And it always means a lot if you have a moment, if you haven't already done it, to leave us a review on iTunes. Love to hear the feedback and the comments. I think we've already gotten over 50 reviews. So thanks again, and hope you enjoy today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Dominic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Dominic Rinaldi.
M&A Unplugged podcast community, welcome back. And today we've got a special episode, a repeat guest, Tad Render from Miller Cooper. Tad penned an article with a small assist from me labeled The 10 Commandments of Selling Your Business, and really is an excellent overview of the things that owners of businesses should be thinking about. I contend from the day you buy or start a business, but certainly a couple of years before you're getting ready to exit the business. And so Tad was a previous guest, I think one of our early episodes, and an episode that has gotten a ton of downloads. The message around accounting and quality of earnings really has resonated with the community. So excited to have Tad back. Tad, welcome.
Thank you for having me back, Dominic. Appreciate it.
Yeah, absolutely. So, hey, Tad, maybe you could start with, you're the head of the transaction services group. Maybe you could talk a little bit about Miller Cooper and your group and what you guys do.
Sure. So Miller Cooper is a Chicago-based accounting and tax firm. We have about 350 professionals located in the Chicagoland area. Our transaction Advisory Services Group specializes in buy-side and sell-side financial and tax diligence and related quality of earnings work for lower middle market enterprises.
Yeah, and you guys do incredible work. We know a ton of mutual clients and really respect the work that you guys do. And so happy to refer anybody at any time. So why don't we dive into this article, the 10 commandments of selling your business? And listen, this is not to offend anybody. This is not in any way a religious slant on anything, just a cheeky, title for what is a packed article of great information. So Tad, that said, why don't we dive into point number one, which is, understanding your goals and objectives as an owner. You can talk a little bit about that. And I think we're going to try to give an example with each of these points as well, from owners that, executed well or ones that didn't. So, understanding goals and objectives. So Tad, why don't you take it from there?
Sure. And I'll start with, there could have been 10 more, but I kind of capped the article at 10. So I think we're going to run through the 10 today. But this first one, understanding goals and objectives, we find a lot of times that business owners' main objective in wanting to sell their business is to take some chips off the table. And if this is the case, there are a lot of different options available to that seller that will allow them to diversify assets without going through a traditional sale process. So, for example, they can leverage the business, and this can include leveraging real estate that's related to the business. They can bring in a minority partner. Even they can consider potentially converting to an ESOP. So a lot of times sellers think they need to outright sell the business when there are a couple other options available to them. Furthermore, a seller always needs to think about what their involvement wants to be with the business post-sale. Some people want to buy the sailboat, and enjoy their retirement, while other sellers want to stay involved with the business, just not in a full-time capacity. All important things to decide before going through the process.
Yeah, excellent points. I will say on my mergers and acquisitions business, one thing that we offer is something called a pre-sale assessment, where it walks owners through, it's a short 7 to 10 minute survey about what would they do after the sale, and what are the things leading up to the sale that are most important to them. It's really a litmus test around, are they ready to move away from the business, or should they consider some of these other options that you're discussing, an ESOP or a recap, or any number of other things that they can do that doesn't mean they're walking away from the business. So with that said, let's move on to number two. And number two is planning ahead. And this has come up, Tad, in so many of my interviews around preparation being such an important piece of thinking through, an M&A transaction, or at least a march towards an M&A transaction.
Yeah, and I will say that we perform diligence on many companies that are run as what we refer to as lifestyle businesses. So this is where the owner's happy making a decent living from the business, but they're really not looking to maximize enterprise value. And that owner can make some tough decisions, whether it's a personnel decision or a customer decision, that can really reap rewards by maximizing the value. A specific example, we were recently looking at a business where the owner had employed many of his friends as independent sales reps with way above market commission rates. And now we're helping the buyer. The buyer's stuck with these high commission rates, and it's really hurt the value of the business. So this is an example where the seller could have made some tough decisions prior to taking the business to market that could really increase enterprise value.
Yeah, unintended consequences, right, of decisions that you make. I mean, we've seen some things on our side as well. We've even seen owners, knowing that they're going to sell the business within the next year or two, go out and make massive capital investments on things that they're never going to reap, the returns from. And it didn't move the needle on value, and it didn't keep the company relevant from a, technology perspective. It was a depreciation, an attempt to, lower their taxable income and add depreciation. It was like, it just didn't make any sense. And so just, thinking through what makes sense as you're marching towards a potential transaction, which gets us really to the next part, which is, point number three, hire an intermediary. Maybe you can talk a little bit about that.
We're always big proponents in a seller hiring a sell-side advisor. And I said in the article, when the typical homeowner decides to sell their business, one of the first people they call a realtor. But a lot of times, small business owners look to sell their business without the assistance of a professional. And it's just a mistake from day one. There's a lot of value add that a sell-side intermediary can bring. They keep things on schedule. They can help a seller through the diligence process. They can help evaluate offers. They can help negotiate those offers. They're always good at playing the bad cop in negotiations with the buyer. I guess the point is, sell-side advisors have done this many times, and Dominic, you've done it hundreds of times, that they understand the nuances of a deal. This may be the only company a business owner ever sells in their lifetime. So employing the right professionals to help you through the process will reap rewards.
Yeah. Look, it seems self-serving for me to be, opining on this particular point, but it's hard not to. I would like to point to a recent example in our firm. We represented a client that was a C corporation, and we knew immediately that there were going to be tax issues around that, because when you have a C corp, you're subject to double taxation at the corporate level and then at the individual shareholder level. And we knew it day one when we met the owner, and we started having conversations with him about that. And interestingly enough, he went to his local tax guy, and they did the tax workup, and they came back with, yeah, you're going to have to pay double taxation. And we knew better because we had done previous, thankfully, many previous transactions where there are options around selling just the stock, or actually the assets out of a C corp, and we were able to help that owner think through that and implement that, and at the end of the day cut their tax bill by over 50% and saved hundreds of thousands of dollars. And so, it's just one of many examples. And I'm sure, there are tons of intermediaries out there that have their own stories around that. So I think the point is well taken. Why not leverage the experience of people who have done this hundreds of times? Chances are they've seen just about everything. And if they're on the ball, they're going to help you through your issue.
Yeah, and that's another example of, I talk about the C Corp structure. That's another example of planning ahead. Even before you have any inkling of idea that you're going to sell the business, that's something that the corporate structure is something that you can possibly change well in advance of a sale to avoid that double tax.
Absolutely.
The same goes for, if you have a goal to pass wealth to the next generation, there are some estate planning techniques that can be put in place prior to selling the business to greatly reduce current and future taxes.
Yeah, excellent point. Excellent point. So number 4, prepare for a long process. I can't believe how many times we meet with folks and they're surprised when we tell them how long it's going to take. But I want to give us your perspective on that.
Yeah, everything takes time. And I wish that transactions didn't take so long to close, but it's just the nature of the beast. We recently helped a medical device company through a sale process, and they went to market. They received 15 plus offers. It took about 2 months to receive and evaluate all the offers, and then eventually select a buyer. That buyer then went through 3 months of diligence, and at the end of 3 months of diligence, they ended up having to back out of the deal. Nothing related to the company that was selling. The buyer had some internal issues of their own, so we were already in it for 5 months. Another buyer was selected, which took time to negotiate. And after 3 more months of diligence, the transaction finally closed. All in, it was a 9-month process. I think the intermediary did a good job of keeping the seller patient and keeping the process moving. But, this was a 9-month process, and a lot of it was out of the seller's hands.
And 9 months is really not an outrageous amount of time.
It's not.
We track our numbers very closely, our close percentages, and at least our close percentages when we get into diligence, and then how long it takes. And right now, I think the average is about 10 months. So it really just takes time.
Yeah, and I think if the seller understands that going into it, it makes the process go that much smoother.
So point number 5, Tad, this is right up your alley. Tee up here. Make sure your books and records are in order.
Yeah, the best way to describe that is, I guess, the best case of having what I'll call, some messy books and records is that it'll delay the process. And in the worst case, it can hurt the valuation of the business. So this kind of correlates to planning ahead. You don't want to start getting your books and records in order as the buyer sends their diligence team in. You're going to want to do it, well in advance of going to market. An example is we just worked on a buy-side quality of earnings where the target had a bunch of unwritten leases. There were verbal rebate programs with some key vendors. There were unwritten bonus arrangements with some key employees. So this delayed the process by at least a month while these agreements had to be negotiated. And it ended up hurting the valuation of the business as each one of these parties used this as an opportunity to renegotiate their deals. And this all related to just having contracts in place that should have been there all along.
Yeah, wow. If you would have just taken the time to just clean that up, how much smoother that could have gone.
Yeah, and I know when you get involved in a sell side engagement, one of your first questions is to start accumulating the contracts and making sure they have everything documented in place.
Absolutely. And there are so many things when it comes to contracts. Are they assignable? Do you need approvals? If so, what do you have to go through to get the approvals? We just went through this with a client, a very large media client that had clients that were, in the Fortune 100 and 500 range. And as you can imagine, there were lots of sticky issues with those contracts, but the client had done their homework and had prepared in advance. So by the time we were going to market, they had done a great job of getting their arms around what had to happen there. And so it just made for a much better discussion with the buyer and then diligence and ultimately on closing the deal. So moving on to point number 6, hire experienced professionals.
Yeah, when it comes to selling your business, you want to consider who your advisors are and to make sure that they have experience in the M&A space. You may have used a great corporate attorney, for years, but if that corporate attorney doesn't have transaction experience, may not be the right person for the transaction. Same thing goes for your accountant. An experienced deal accountant is going to make sure your financials can stand up to the scrutiny of a buyer or buyer's advisors. An experienced deal attorney can help you negotiate the purchase and sale agreement of the business. They can also protect you from reps and warranties that are going to be included in that purchase and sale agreement. I have a great example of this. So it's not on the accounting side, but it's on the legal side. We had a client in the toy business that sold several years ago. About 18 months after the sale, there ended up being a substantial product liability claim. Fortunately for the seller, they had a very experienced deal attorney, and that deal attorney included a provision in the purchase agreement that the buyer assumes all product liability claims, past, present, and future. This is something that could have easily been overlooked by a non-deal attorney. Long story short, the buyer of the business brought suit against the seller. The case was dismissed, and the seller was well protected. It's little tiny nuances of having an experienced deal attorney.
Yeah, I mean, that's a great good news story, right? I wish I heard more of those, but that's awesome. I'm always surprised, Tad. I don't know about you, but I'm always surprised. I have a lot of clients who come in the door and they've had an attorney or accountant that they've used forever, and I understand the allegiance to those people, right? I mean, they've gotten them to where they are today. Maybe in many cases, they're really good friends, right? But if they're not experienced at M&A, one of two things is going to happen, right? They're going to go to school on your dime, which means the meter is going to run, at an incredible clip, right? Or two, they're going to make mistakes and miss things like what you just mentioned. And typically, I think the statistics are that somebody's business is within their top 3 assets, if not their number 1 asset. Why would you leave, one of your largest assets at risk by not, going out and hiring somebody who really specializes in M&A transactions, who does a lot of them, has seen everything and knows how to protect you down to, like you just said, past, present, and future. You don't want to miss those things. That could really come back to bite you.
Yeah, luckily for the seller, they used an experienced deal attorney.
So, number 7, present your financial statements in the best light.
So this gets back to maximizing the value of your business and making sure you're fairly compensated. So a lot of times in the lower middle market, the valuation is based on a multiple of earnings before interest, taxes, and depreciation, is referred to as EBITDA. So making sure that your EBITDA is maximized. So what we do as deal accountants is help sellers identify and quantify adjustments to EBITDA that increase the historical reported earnings, which has a direct result in valuation. So, for example, right now we're helping a company quantify the P&L drag of an unprofitable business line. The company, had they listened to this podcast previously, they would have planned ahead and abandoned this product line, but they still have an unprofitable product line. And we're presenting pro forma income statements without the impact of this product line. So in this situation, it's going to create up to $100,000 increase in annual earnings. So at a 5 multiple, we're talking $500,000 of additional enterprise value just by being able to isolate this unprofitable product line that's going to be dropped on a go-forward basis.
Wow, that's tremendous. Boy, that's earning your fee and then some.
And I'm sure I know Dominic, you run into this a lot in trying to help sellers just present the financial statements accurately, but in the best light possible.
Absolutely. And sometimes here's the frustration that I see, Tad, and it happens so much. People will come in, they're very close to deciding they want to sell, right? And they come in and we do the workup for them and we present the findings and we give them our opinion on the range of value, and they're disappointed. And the reality is that with some advanced work, they could have done some of the things that you just described, but now they have to go back to the drawing board and they're going to have to spend a year, 18 months, 2 years undoing some of the things that they did in the past so that they can maximize their financials and show, the highest amount of EBITDA. But they've come to us at a point in their lives where they're burnt out or they're ready to go do the next thing, or, they're just done. And they may or may not have the energy to go back and run the business for another year or two. And oh, by the way, that assumes that the economy is going to, cooperate and things are going to continue to go well, right? And you're not going to suffer a downturn unrelated to anything else. So it just goes back to the point we talk about all the time. Don't wait till the day you decide you want to sell. Be doing this work on a regular basis. It's so much easier to call you and your firm, Tad, 5 years ahead of time or 10 years and start that dialogue. And then they know how to run the business, and then it's not a surprise. Or come to us or, any number of professionals that can help them think through how to get their financials in the right order. Number 8, this is a good one. Disclose everything.
Yeah, and keep in mind, we're referring to kind of significant valuation movers or deal killers only. We don't need to be a 100% open book. But if we have a significant issue, there is no good that can come out of sweeping the issue under the rug. Here's a perfect example. We had a client in the marketing business that did not disclose the potential loss of a significant customer. In this case, the buyer did successfully sue for a breach of reps and warranties, receiving a fairly large judgment. They received the $1 million that was in the indemnity escrow and another $500,000 in damages above and beyond, legal fees, and everything else that went along with that, because the seller in this case was not proactive in disclosing this potential loss of a customer, which they knew about, but decided to sweep under the rug while the buyer was performing their diligence.
Yeah, so important. It's a great example. We've got a live one right now, literally a deal that's marching towards the closing table. And we learned that a key employee is leaving. And We counseled with the seller and we're like, listen, you've got to get ahead of this. It's going to be a hole. You're going to have to deal with it. You don't want to deal with it after the fact because it'll bring up all these indemnification clauses. Let's just get ahead of it. And interestingly enough, the owner and the buyer and my team met and they went through the issue and they came up with a plan, jointly came up with a plan on how to mitigate the loss of this key employee. And the buyer was so appreciative, and the trust level between all the parties went way up. And so now, this is, and everybody can sleep well, everything's out there, it's material, and they came up with a joint solution, and it was fabulous. Now it may not always end that way. In this case, it worked out, but you don't have a choice. You still have to disclose those items to people.
You do, and that's a great example of it not being a negative to the transaction. I said in the article that everyone should look at this as just another negotiation lever, because undoubtedly there's other positives, that we're happy to disclose as we go through the diligence process that can help mitigate some of the negatives. So the point being, we don't need to disclose every little thing, but if there's a material valuation mover, or legal issue that is no good can come of it.
Yep, absolutely. All right, number 9, evaluate all buyers and offers.
Yeah, and this is probably, this is right in your wheelhouse, Dominic. But the highest offer may not always be the best. It depends on what the goals and objectives are of the seller. If an earnout can get to a higher valuation and it's probable that earnout's going to be met, then that may be the better answer. You also got to consider the tax implications of the offer. For example, is it an asset versus stock offer? Big tax ramifications that are drastically different on how the offer is structured. So having your accountant understand that and explain that to you and run kind of after-tax cash flow projections is important. But anything else you want to add, Dominic? Or
Yeah, so I take this one two ways. One, just cautionary to owners that it's nice to have multiple offers. And I talk to a fair number of owners who have their own buyer or go down the path with one buyer. And in some cases that makes perfect sense, but in most cases, I would think you'd want to understand confidentially, right, what the market's willing to bear for your business, and having multiple bidders really reveals what the market's willing to do. And I usually find that you have multiple offers, one or two buyers are more motivated than the others, and they're willing to push the limits on not just price but on terms. In the example that I have in this category is we had a large fabrication company a number of years ago, and we had I think it was a total of 9 offers on this business. But one group in particular was really listening to the owners. There were 2 partners. One was ready to retire, long since done. The other one wasn't so certain he was ready to retire. And there were higher offers that came in, but this one group came in and really made a tremendous offer where one of the partners would stick around in a management capacity, significant management capacity, with equity and with some real upside. And while the offer wasn't as high as the others, it hit the mark for that particular partner and they won the deal. And that's just because they were paying attention. They were really listening to the owner. They took the time, and the owners, really appreciated it. And they evaluated all the offers, but for them, that one worked, even though it wasn't the highest price.
Absolutely. It stresses the importance of, in situations where it's not an outright sale and the seller or one of the sellers is going to stay in the business, it's critical that you get along with your new partner.
Yeah.
So use the diligence, kind of the diligence phase and the offer phase as a way to kind of date your new partner.
Absolutely. So number 10, Tad, we're here. We're at the end, last one. And I have a great story on this one, but I want to hear yours first.
Well, this somewhat relates to one of the earlier topics of a transaction taking time and being prepared for a long process. back to that medical device company, I use the example of a nearly 6 month passing before the first deal ended up falling through. And luckily, the ownership continued to focus on the business. In the interim, they were able to land a new customer in that time that ended up creating a higher valuation in the end when the second buyer came in 6 months later. So that's a great example of a seller kind of continuing to focus on the business. We have a lot of scenarios where it's the opposite, and the seller decides one day to sell their business and stops focusing on the business. You never know what's going to happen. And so oftentimes, I don't know if I'm sure you've seen this, Dominic, where the business starts to turn the other way and the enterprise value is injured.
In fact, that's my example of my story I want to share is we had a client about a year and a half ago, roughly, and it hits on a couple of the points. It hits on, this is going to be a long process, which we tell everybody repeatedly from day one. And this owner luckily had really made all the money they needed to make, was ready to retire, wanted to sell the business, engaged us to sell the business. And we were about 5 months into the process and we had a couple of offers. And we asked for updated financials. We got them, and the business was off by about 40%. And we were shocked, because everything had been tracking. And then all of a sudden we got this updated report. And these are true words. The owner said to us, the day I signed the engagement agreement, I really, kind of took a couple of vacations, and then I took a couple of more and totally stopped focusing on the business, which is point number 10, right? Focus on the business. And luckily the business got sold, but nowhere near what he had originally hoped for, or at least the terms weren't anywhere near what he had hoped for, because the business was in essentially a free fall. And so he just took his eye off the ball. Now that's a pretty extreme example. There are lots of other ways that people take their eye off the ball, and it has an impact on value or, on the terms that you're going to get. So really need to understand the day that you decide you're going to sell is the day you should probably work harder than ever, because you want it to go smoothly, have the business rocking while you're in the process. Tad, this was, really a great article that you penned here. I appreciate the small contribution that I was able to have in this. Would you like to maybe just wrap a bow on this for us? Give us your high level, and we'll wrap this up.
Yeah, well, I know we talked about, a lot of topics today, but if a seller can focus on, even a couple of these items that we discussed, it's going to help expedite the process and hopefully maximize the value of their business.
Yeah, it's great. Great point. Tad, such a pleasure to have you back. If folks wanted to reach you, how would they get a hold of you?
My email is trender@millercooper.com. Also contact me through our website or LinkedIn.
And that's TRENDER, T-Render, right?
Yep.
All right, Tad, thank you so much. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit our website at sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.